Hello, this is Prof. Aram, and in this video I will go over the practice of analyzing financial statements. So now that we have learned what are the main financial statements, what is a cash flow statement, what is an income statement and a balance sheet, now our task is to learn how to analyze them. And one way to do this is by looking at ratio analysis and common size financial statements. When you look at the income statement or balance sheet of a company, you see dollar amounts, and those numbers in financial statements do not mean much on their own, especially if you're comparing firms of different sizes or firms in different industries. Ratios make them meaningful by providing comparability through time for a single firm or across firms. In other words, when you look at the ratios, you're going to, for example, compare the ratios of, let's look at Ford, for example, Ford over the past few years, right? Meaning that you compare the performance of one company over time, or you can compare the performance of Ford with GM and Tesla and Toyota and other car manufacturers. So either compare the performance of the same company over time, we call these a time series analysis, right? Or compare the current performance of Ford with other car manufacturers, we call this a cross-sectional analysis. You need to know that ratios are the language of the business, and finance people love to create them, talk about them, flip them upside down and break them into parts and etc. And they help us understand these financial statements better. As I said, just looking at the dollar amounts in the balance sheet and income statement, we can't really tell much about the financial health of the company. For example, let's say Cisco Systems had $11.6 billion in net income in 2019. Is it a lot? Not enough? It's hard to tell without the context. What if you know that the profits were 22% of the sales? Might seem like a good number, but it's still, you can't tell because you're not comparing it with anything else. For example, you might say, okay, this is a good number. This is a good profit for 2019. But if I tell you that in the previous years, the profits were 30%, 28%, 33%, right? And then now 22%. Now it seems like they may not have done really well this year. What I'm trying to say is that when it comes to ratio analysis, you need a context. You need a benchmark. You need to compare your ratio with something else in order to be able to make better decisions. Same thing is true for the other point. Like 14.5 billion in long-term debt, is it a lot or not enough? You have to know your context in order to be able to make better decisions, make better forecasts, or make better recommendations for the company. So in terms of ratios, we are going to have 4 broad categories for ratios. The first one is the liquidity ratios. In other words, can the firm generate cash quickly? The second one is profitability ratios. How well is the company generate profits? And next, we're going to look at the leverage ratios. How does the company finance the assets that is owned? What are the sources of capital used to pay for those assets? And finally, we are going to look at the productivity ratios, which is basically the company uses the assets efficiently. All right, and then I didn't list it here, but we are going to look at the market value ratios as well. how the outsiders of the firm, how the markets are basically pricing the activities of the company, how shareholders are perceiving the company as a whole. I hope you find this video useful, and in the future videos, I'm going to go over each of these ratio categories in more detail. And thanks for watching.